So welcome back to the Kickstart Garage. I'm your host, Sam John Byrne, and I'm accompanied by my co-host, Gavin Quigley. On today's show, we're joined by co-founder and chief investment officer of MyWallSt, Emmet Savage. Welcome to the show, Emmet. How are you?
Thanks very much. Delighted to be here, Sam. I'm very well.
So before we get into MyWallSt, could you tell us a bit about yourself and where your interest in investing stems from?
Sure. Well, I suppose my interest in investing comes from the fact that passing interests ultimately morph into habits, and those habits into pursuits. And then I suppose obsessions, or at least complete preoccupations, stem from ultimately passing interests. So I became what I did, and I've invested so much in the early days. I essentially became what I am today, which is the co-founder of MyWallSt, and as you said, a chief investor.
Very good. And you're currently chairman and chief investment officer, like Sam said, at MyWallSt. But it all started with a bachelor's degree in something that I would describe as literally my worst nightmare, applied physics. I did physics back in school and did not enjoy it for the leaving cert. But is there a connection between this early stage of your career and where you wound up, like a devotion to numbers or a fascination with formulas, perhaps, something like that?
I'm not sure if there is a connection. It might be as much a statement that I should not have studied physics more than anything else, although I was okay at it. I remember on my first day in DCU in 1992 sitting in their largest auditorium and the head of the faculty saying that only 1 in 4 of us would make it to graduation, and something like only 1 in 12 would do it without ever having to repeat an exam over the summer. So that actually became my goal, not to have to repeat anything because I didn't want to ruin my summer. And sure enough, I graduated from physics having not had to repeat like a single exam, which is really, when I think about it, the most ridiculous barometer of success. What I say in physics, what I'll say in physics' favor is that, for me anyway, everything you study thereafter is a walk in the park. And I did a HDip in finance a few years later, and then a master's in business strategy a few years after that, both of which were far more aligned with my real interests in stock investing. And as far as I was concerned, way easier.
Very interesting answer. I think a lot of people probably wonder what it's like to go through that kind of educational process. I've only ever done a commerce degree in UCD, which I'll even be honest myself was fairly easy, like in terms of just passing and throwing the hat in the air at the end. So it's interesting to know what it's like. Some of the more difficult degrees out there. You recently moved roles though, Emmett, and I saw this from your LinkedIn, from CEO to chairman and CIO. What has this move meant for you, I suppose, in terms of your roles, your responsibilities, and is your day to day much different now?
Well, I co-founded MyWallSt with my old friend John Tyrrell, who's more talented than I am in certain areas, and maybe I'm stronger than him naturally in other areas. So since day one, we've worked extremely closely. So it's a very natural progression that plays to both our strengths. What it means for me is that I can dedicate myself to what I love and what is one of my strengths, which is long-term buy and hold investing. So what the change really implies is that John is playing to his strengths and I'm playing to mine, and we're both freed up to spend more time doing what it is that I suppose we always envisaged from the outset.
Very good. Yeah. And I noticed that, we'll move into MyWallSt now. The LinkedIn account, it's really active. I was looking at it there over the last couple of days, just in preparation for today. Really active, post regular content relating to investing, current affairs in the financial world. A lot of value there because, there's so much noise out there, but it's great to get those just little contextualized bits of info that you're getting with these pieces of content and these posts. Like, would you consume a lot of investing related content yourself each day in terms of like different websites, different newsletters, things like that?
I do. I think since the dawn of media, people have overlaid whatever was available to them on top of their free time, whether that was reading, let's say, the Wall Street Journal newspaper on a daily train commute in New York in 1950, or engaging in TikTok while lying on bed and on Saturday in Sydney in 2021. And I should say that neither of those apply to me. But I have filled every time gap in my day with media, and I subscribe to Wall Street Journal, Bloomberg, Fortune, and of course the Motley Fool. And I read on off all day, every day. So I'm constantly grazing at information. And then I have solid blocks of time during the day where I spend 2 hours reading. So yes, I am very much a believer in consuming as much as possible.
It's hard to avoid analysis paralysis as an investor, especially when you're starting off, I find, but there's so much. My question is, with such a deep passion for investing and an excellent market beating returns of 24% for the last 2 decades, why did you decide to start MyWallSt over, say, starting your own investment fund where you manage other people's money?
That's probably the question I get asked the most. And if if my personal life objective was to maximize my earnings or my net worth, then that would have been a more logical path. But it's not what I wanted then or now. Like MyWallSt is a purpose-driven company. We're out to do something far, far more impactful than just managing a fund. Our purpose is to inspire a generation to own their financial future. And that's huge. Like, it's uplifting. It should be inspiring. Like, John and I have surrounded ourselves with immensely talented team with that objective. And we needed to do something that spoke to people who wanted to change their life as opposed to those people who already had changed their lives and had enough wealth to hand over to somebody else. Now, with that said, there is a chance that MyWallSt will start a fund, but you only live once. And there are a lot of fund managers out there, but there is only one MyWallSt, and we're just doing something far, far bigger and far more impactful.
I think Buffett shares the same mindset in terms that he likes to be thought of as a teacher also. So yeah, no, I'm with you on that one. So, but according to the front page of your website on MyWallSt, it's amassed 3 million downloads, which is insane. So congratulations on that. But I was wondering, how did you manage to scale it to achieve those 3 million downloads?
Yeah, I can confirm that is true. We're probably approaching 4 million at this stage, but only 9% of people who downloaded MyWallSt app got there through an advert, which I'm told is very good. So we're 91% organic downloads. Someone came to the world with a problem and found us. So I'm not going to divulge the smaller detail of how we did that, because I think that's down to MyWallSt's DNA. But I will say that the more you give free of charge and the more you move towards earning trust, just like you are both doing with your podcast here, with each passing episode your audience's engagement deepens a little, their trust in you grows, and then hopefully the number of folks that tune in grows as a result of that. So really, you cannot assume trust, you have to earn trust. And what MyWallSt has done from the outset is seek to earn people's trust by constantly, I suppose, explaining things in a jargon-free way that adds value to their lives.
Yeah, I mean, it reminds me of the first time I ever kind of came across that principle was reading the Gary Vaynerchuk book, Jab, 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 Right Hook. He speaks on a million different things, and I think he's quite a polarizing figure. But that ideology of give, give, give before you even think about taking, I think is quite a robust marketing principle, and I think it definitely makes sense in this instance. What I wanted to ask, there's something that stood out on your website, on the MyWallSt website. It was the graph that was illustrating the stocks are up over 50% on average, easily beating the S&P 500 in recent years. Now, like, I'm definitely a novice, especially compared to Sam, definitely compared to yourself, Emma. But basically, from the books I've read, I understood that consistently beating an index like the S&P 500 is pretty much impossible. Do you expect to continue this excellent trend in performance in the long run?
Well, actually, what you said is wrong. I know it's out there, but it's absolutely not impossible to beat the index. And I agree it's not easy, as the S&P is an index of 500 segment leading businesses, each of which is packed with smart people charged with maintaining and growing market share. But the data is there that individuals can outperform the average, but it is a game of time proven strategy, time, and psychology as opposed to anything else like IQ and formal qualifications. And I can cherry pick any number of examples to support the pushback I gave you, which is that you can outperform an index over the long term. And there's a great book called The Davis Dynasty, 50 Years of Successful Investing on Wall Street. And the book basically outlines the life of Shelby Davis. I don't know if it's junior or senior, I forget, but let's say Shelby Davis Senior, who in 1947 quit his job as a state bureaucrat and with $50,000 of his wife's money took the plunge into stock investing, which by the time he died in 1994, he had multiplied 8,000 fold. So this guy was an extremely conservative investor who mostly bought insurance stocks, added cash. Now, 50 grand in 1947 was a lot of money, but I can tell you multiplying 50 grand by 8,000 in a lifetime is way, 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 way more money. So there are individuals who have completely outperformed the average returns on a sustained basis. There are very, very many of them. It's just a game, as I say, of time in the market and temperament.
Very good. A great answer, and I wanted to ask as well. From what I gather, and I've looked into the website and the app a little bit. MyWallSt is currently focused solely on picking stocks, providing resources to investors to learn more. And we recently had Chris Burge of Spark Crowdfunding on the podcast there last week, and it kind of led to me wondering whether you'd ever offer analysis or advice on other investment vehicles like earlier stage companies or things like REITs. Cryptocurrency is obviously quite prevalent at the moment, or even corporate or government bonds.
Mm. We absolutely started with what we know and love. And in the year ahead, MyWallSt will move outwards into adjacent areas like earlier stage investing and other options for cash. In fact, we're currently building a really powerful and really beautiful product called MyWallSt Academy for that purpose. That said, I don't think we'll go too deep into crypto in the short term. I agree. There's so many different asset classes, and we know where our strengths are. Crypto, we currently don't have strengths in that area. We have a reasonable grasp on what's out there and the differences between them. But yeah, there's a lot of different assets out there, and I think the next logical step for us would be probably smaller early stage companies and probably REITs as well.
Know your circle of competence, isn't it?
Oh, for sure.
Like, as I mentioned earlier, there's a realm of information out there at the moment that it's very easy to get stuck in analysis paralysis. And you could spend a long time trying to develop a conviction in a stock because of that. I was wondering if you could talk to us a bit about your strategy and what you focus on when you're looking to put money on the table.
We all want formulas for everything, and I have done my best to codify, if you like, the formula I've used to pick stocks my whole life, and I'm going to describe it to you. But I don't slavishly adhere to what I'm going to describe. There is definitely attributes I look for in businesses, and people who've heard me speak before are familiar that I believe in a left brain, right brain approach to assessing your investments. And on the left side of your brain, which I'm told is the side of your brain that processes numbers, there's kind of five quantitative barometers, if you like. So you can measure these data points with numbers, and that's high insider ownership. That's where the businesses inside, the individuals inside a business have somewhere between 5 and 40% of the equity in that company. The market capitalization, or the total number of shares that exist in a company multiplied by its current share price, is known as its market cap. And loosely speaking, that's the number you'd need to buy the entire company, which isn't accurate at all, because if you went to buy a company, other dynamics come to play. But the market cap is second number. More cash than debt. I prefer businesses with more cash than debt because it's harder for them to go bankrupt, and that's very easily understood when you look at the statistics of a business and see that its enterprise value is lower than its market cap, when you see that it has more cash and debt. We want businesses with great return on equity. And that means something like 20%, give or take. And a business with a good return on equity or great return on equity inherently has a barrier to entry or an economic moat, because it can actually have these returns on capital. And then the fifth and final number that I look at is growing sales. Like, we want businesses that every quarter and every year are growing sales year on year, quarter on quarter. So they're kind of the numeric things, attributes I look for in a business: high insider ownership, market cap, more cash and debt, great return on equity, and growing sales. On the right side of the brain, it's a far more important part of how we as creatures make decisions. We look for businesses with strong company culture. I look for companies that have a sustainable competitive advantage. That's a strategic framework, I guess. Evangelist customers. I mean, who's bought anything anymore without looking at its star rating, whether it's Trustpilot or the App Store, whatever. You assess the store. You don't watch a movie anymore. You don't watch a TV show without looking at IMDb. We need to know that there's evangelist customers out there. A growing industry speaks for itself. That's the fourth kind of easy to a right brain activity. And visionary leaders. A woman or man who's preferably at the helm of the business, who has a vision for something far bigger than the business we're looking at today. So what I do is I've shot an awful lot of information at you there, but between this left brain and right brain activity, I meld it together. I assess a business. Those 10 things are always considered by me. I don't sit down with a crayon and put a big green tick or red mark against each of them. I do it at a point, just as part of my research process, but other things might come to play. But broadly speaking, those 10 attributes are something I absolutely always look at and prefer to see positive kind of traffic light for before I move forward.
And when you're assessing your investments based on those tenants, do you pull the trigger when they match all 10 tenants, or do you say if it's got, say, the majority? I know Brian Feraldi of Motley Fool, he uses typically a checklist when doing his assessments. If it's over a certain percentage, then he'll go in. But what was it like for yourself?
No, I don't. I don't do that. And I'm familiar with Brian's checklist. I've certainly observed it. And for me, investing has a like successful investing successful or great investments don't always fulfill everything on a checklist. So I don't like adhering to a system that there has to be a score above a certain number before I go ahead. And I have made plenty of investments where, on those 10 attributes that I just called out, many of them were red, on the traffic light system, but still turned out to be magnificent companies. But it's nice to have it as a roadmap or guide rails. But I certainly don't, as I say, adhere to them, that I need to see all of them in a positive mark before I move forward.
Yeah, I'd agree with you. My next question is that a bit of a story as well. So back in 1949, Ben Graham published The Intelligent Investor, and one of the first lessons of the book is the distinguishing between the enterprising investor and the defensive investor. The defensive investor being unwilling or unable to put the time and effort required into being an active investor. So typically this cohort of investors would look to invest in their pension fund, uncorrelated asset classes, any type of passive investment vehicles. However, in Ireland, I feel the defensive investor is almost at a disadvantage to, say, international investors or even the active investor, primarily because passive investment vehicles, usually ETFs, are taxed at 41% on disposal or unrealized gains every 8 years. There's also the PRIPS legislation set at an EU level, which is kind of crowding out low-cost investment funds. I was wondering, for those investors, which I'm assuming might be the majority of people listening to this podcast, where do you think is the most logical place to invest their funds?
Hmm. Well, there's a lot of tax professionals and academics out there who are vastly more informed than I am on the subject. So I have to first say that I'm shouting down from the balcony of ignorance. But nonetheless, I do have an opinion. And it's that all aspects of tax in this state are geared towards inhibiting the aggregation of wealth. And I completely understand the need to build a tax system that ultimately distributes advantages to everyone in society, like schools and roads and hospitals and the Gardaí or police, you name it. But 33% capital gains tax in Ireland versus 20% in America. That tax level blocks decision making and ultimately the flow of capital. So at a CGT level, this country is broken. And then, as you say, in my opinion, and then, as you say, unrealized gains on ETFs every 8 years is utterly preposterous and downright wrong, again, in my opinion. So, yes, I do think set it and forget it investors, which Ben Graham called, as you said, defensive investors, are on the back foot. I'm firmly of the mind that even passive investors need to buy a handful of self-selected stocks that align with their risk tolerance as well as their view of where the world is heading. And it could be as simple as buying a few Apple, Google, Netflix, Starbucks, Amazon, or whatever once or twice a year and leaving it there for the very long term. And what you're doing when you do that is you're effectively building a synthetic ETF. You're building a something that mimics an ETF. They're household names, big brands, global presence. I wouldn't say they're indestructible, but the barriers to entry on those businesses are very, very high.
Yeah, usually like when people ask me, the first thing what I thought of a solution would be a low turnover, simple quant strategy, something similar to the Acquirer's Multiple or Magic Formula, even by Joel Greenblatt. I think that's a kind of a good similar.
I loved that book, and I haven't read it in years. Magic Formula, the little book that beats the market, right, by Joel
Yeah,
Greenblatt. So he, yeah. So one thing about that book, if I recall, is that when it's probably 20 years out at this stage, but I think if you go back and back test the Magic Formula, I don't think it was so hot. Now I stand to be corrected. So I did really, really love that book when I read it, and the returns that were synthesized with whatever he had at the time, I think it was like 137 years of data, were mind blowing. It's like, holy schmoly! If you just applied a simple rule, you are going to smash the market. But I'm not so sure it played out. But look, I have to check. I haven't read the book in a very, very long time.
yeah. No, I remember chatting to. I'm not too sure you follow him on Twitter, Value Stock Geek, but he has done kind of kept up to date and it hasn't been performing as well as it did in the past. But yeah, I think that's similar with a good few strategies. So I just want to say I started investing around 16, and as I progressed, I've begun to see the importance of finding an investment strategy that works for you. As Warren Buffett has said again, there's more than one way to get to heaven. And throughout the years, I've cherry picked elements of various strategies from Michael Burry, Peter Lynch, Howard Marks, and I've incorporated them into a framework quite similar to tenants that you have yourself that works for me. With that said, as you've gone through your investment journey, what investors have had a big impact on your strategy, and what kind of elements have you taken from them?
Well, I absolutely love Peter Lynch, and equally, I've also read every one of Berkshire's annual letters and listened in when I can. But I probably have taken most inspiration from David Gardner, who, as you probably know, is one of the co founders of The Motley Fool and someone who I am privileged to count as a friend. And David, I think he stepped back from, well, I know he stepped back from writing his Rule Breakers newsletter for The Motley Fool, but he was a huge inspiration to me over 20 years ago. And he's a visionary and also very brave in his decisions, which time after time after time played out as incredibly astute. Unlike a lot of other investors, such as the ones you mentioned, David was outward facing. His best investment ideas were there for all to see and not for the preserve of the elite. And hopefully I can pay that forward through MyWallSt and specifically the Horizon service that I run, which applies everything I've learned to find a lot of the next wave of big winners. And I should mention, by the way, should I my usual troll have a go, that Motley Fool and Motley Fool Ventures both invested in MyWallSt.
Fantastic. Certainly very good to have someone like David in your network early on. Um, Charlie Munger, who is still going strong at the ripe old age of 97, I believe, he recently came out and he said, and I quote, "It's most egregious in the momentum trading by novice investors lured in by new types of brokerage operation like Robinhood. And I think all of this activity is regrettable." So, as someone who's considerably experienced in investing, What are your thoughts on the prevalence of these new investment companies and encouraging trading among young investors and offering these dangerous methods of investing, such as call and put options?
Broadly, I dislike it because these companies are more concerned with trade volume than they are with ensuring their customers are guided and making the right decisions for their financial well-being. Um, Metrics of success for companies like Robinhood are probably total number of customers, total assets under management or assets lodged with the business, and then total number of trades. I doubt in their top 10 of priorities is customer well-being. Does it even figure? But I am aware, however, that from the Robin Hood brigade, a small subset will emerge who in 30 years from now will have legendary returns, which they will partially attribute to Robin Hood for getting them going. I don't have the stats, but I suspect for every 10 people who start investing, 10 get to experience the downside, and something like 8 of them just can't hack that for several reasons and give up. When MyWallSt integrated our brokerage partner, who are called DriveWealth, and who are also the back end broker to Square and Revolut, we specifically said that we did not want and would not offer anything that skews with our investment principles, such as margin trading and options. So, a MyWallSt customer who downloads the MyWallSt app and takes a 7-day free trial and then decides to open a brokerage account with DriveWealth through MyWallSt, they can't, to the best of our ability, do something that shoots themselves in the foot. And that's something we specifically wanted from the outset, because we really, I learned a lot of the hard lessons the hard way. I learned all the good lessons the hard way, rather. So, and some of all of those are incorporated into MyWallSt's DNA.
Staying true to your colors. So I'm not too sure if you've seen it on Twitter. There was a graph that kind of went viral in the investment space there a while back, highlighting the annual outperformance of selected investors against the S&P 500 by years. And the only investor to outperform the market over 60 years was Buffett. Investors like Nick Sleep, Joel Greenblatt, Peter Lynch outperformed the market, but only for the course of 10 or 20 years before they stopped. And you can see investors such as Bill Ackman, Manish Pabrai, Guy Spire, Sir John Templeton began to underperform the market as time went on. And I was wondering, why do you think that is?
Hmm. Well, Warren had several advantages. In his own words, he was born in the right part of the world at the right time, and at a very early stage, had the right mentor, who was Ben Graham. But all of the advantages that he enjoyed, or of all the advantages he enjoyed, the absolute number one was runway, or time until completion. Like Warren Buffett made his first stock purchase in 1942, which is 79 years ago. And he's still at it. He started when he was 11 years of age. He was nearly 8 decades at it. And he applied, I suppose, he applied a strategic process with absolute rigor. And the other names, so your question was, why did the other names underperform the market? Now, I can't say for sure because I haven't studied that per se, but the bigger the ball of money that you have to manage, the harder it becomes to perform. And Warren Buffett said that if he was only managing a multi-million dollar portfolio, he'd return 50% a year. And it's just when you move into the hundreds of millions and then billions and then tens of billions and then hundreds of billions, as Berkshire and very many other, well, not very many, but other firms do, the bigger the ball of money, the harder it gets to manage. And I'm pretty sure that that is what happened. I know Peter Lynch, I think he just retired. I think he took over the Fidelity Fund and like kind of late 70s. Is that right? 70, 80s. He certainly managed it throughout the 80s. Yeah, I'd have to see his time frame, but I know he retired, so he is an investing legend. And he did that being hyper diversified. The guy had thousands of stocks and still managed to outperform the market. Like the S&P 500 was more concentrated, and he actually managed to outperform it by with thousands of stocks. Incredible performance. So I wouldn't quite say that it just fell off. I think he just retired.
Just on Peter Lynch as well, while we're talking about him, there's a great quote: "If you spend 13 minutes a year on economics, you've wasted 10 minutes." So I just want to kind of move away from strategy for a bit and talk about kind of portfolio management with the rise of, say, Bitcoin, Fed skeptics, inflation rearing its head, and there's many more investors making decisions based on the macro environment. Do you alter your portfolio at all based on the macro environment, or how have you positioned your portfolio?
No, never. I've invested in three of the five biggest US market crashes, which were so the five biggest crashes in US market history. 1929 stock market crash, Great Depression, obviously long before I was born. 1987, I was still a child in the single digits. Then the next biggest crash was the dot com bubble. I was invested during that. 2008, the financial crisis, I was invested throughout that. And 2020, the coronavirus crash, which I was invested. So I've invested in through three of the five biggest market crashes of the last 100 years. And it's beyond me to fuse a time proven investment strategy with economics, which in itself is an entirely different area of expertise. The social science revolves around the relationship between individuals and societies. I don't know any successful investor who has a macroeconomic sponsored strategy. I've never heard of them. And all these books over my shoulder, of course, it feels like the right thing and a smart thing to do to talk about macroeconomics. But the reality is, at any time in history, there's always a great investment right now.
Yeah, I'd agree. There's so this is kind of just my last question before I hand over to Gavin. There's an investment community joke that technical analysis is basically just astrology, and with that said, I've found some bare bones technical analysis kind of creeping into my own investment strategy over the years, just for gauging market sentiment. I found it particularly helpful, but I wouldn't necessarily use it for companies I'd be holding for a long period of time. It's kind of short term. Do you ever use it for your own strategy, or have you ever used it? And what are your thoughts on technical analysis?
No, I don't use it. I've read a few books on the subject in my early days, but settled on long term buy and hold, which, as I said, apart from being the most certain way of beating the market, allows you to ignore things such as moving average, convergence, divergence, and all these other signals. Really, there are very few people emotionally equipped to commit to a 30 plus year strategy based on technical analysis. Like, you got to decouple from that. It's like, it isn't easy. I'm not saying that a long-term buy and hold strategy is easy. Well, it's simple, but it's not easy, as Warren Buffett said. But when you bring in technical analysis, you really need to know what you're doing and have the energy of a god to keep it going for 30 plus years.
We're going to finish up very soon, Emmet. You've been absolutely fantastic, and my mind is spinning with all this new information. I love it. Can't wait to listen back. I have two more questions to ask. One of them, I'm taking it from a Tony Robbins book that I read. Now, I don't know how familiar you are with Tony, but I went through a phase a couple of years ago where I just read all of his books. I was consuming all of his content, and he's got an investing book. He has a couple of investing books, financial focused ones. There was one book where he went around and he interviewed really popular, really famous, successful investors. And one of the questions that he asked each and every one of them was, if you had to leave everything you own to your family with just a few core investing principles, and not just to leave it in, let's say, like a bank or a pension fund, what would those key principles be and why?
My Wall Street has six golden rules, and it's these principles that I would ask that my family to adhere to. And in fact, one of them would be fulfilled by default, which is get started. So, if I had to leave my portfolio to my family, the five rules would be: think long term, never borrow money to buy shares, diversify, buy what you believe in, and invest what you can when you can. Now, it depends on how much space I'd have on the page of instructions. I'd elaborate on each of those six rules, five rules, if you like, because they've already got started. But thinking long term is the key to unlocking wealth. Never borrowing money to buy shares, diversifying, buying what you believe in, and investing a little often. They are the keys to creating generational wealth, and I would that's what I would ask of my people.
Fantastic. I know it's a bit of an unfair question to ask for a few key principles and not elaborate on them, but those are fantastic. I'll certainly be making a note of those. a lot of people, and this is my final question for you today, Emmett, before we let you go. A lot of people choose investing as a strategy towards retirement, as well, of course, as building some generational family wealth. That's the long term principle for a lot of people. Do you have a personal, like, long term purpose behind your investment strategy, or a point at which you would simply retire from investing, or just shift everything to be a completely passive portfolio, and focus on other things in life? Or would you always be, do you always want to be around
No.
it?
No way, man. For me, stock investing goes far beyond wealth creation or some kind of hobby. Yeah, yeah, no, this is this like stock investing is a comprehensive, unending stream of lessons. Like stock investing teaches you about the behavior of everybody else, how humankind responds to world events or company specific news. It teaches you about new industries and even old businesses doing something that you never even heard of. You learn about how you respond to trouble, and it also teaches you how to respond the next time. Like stock investing unlocks a deeper sense of purpose, I suppose, and it ultimately allows you to help others, be that through teaching or economically. So, and the great thing about stock investing is it demands nothing. You can take a week or a month or a year off and return as you would to, say, a musical instrument, and pick up where you left off. And that is why I love it.
That's a great way to finish the show. So I think we'll wrap it up there for today. Emma, thank you so much for taking the time out to chat with us. It's been an absolute pleasure. For someone looking to find out more about yourself, MyWallSt, where should they go?
Go to mywallstreet.com or go to their local app store and look for My Wall Street. And we have one of the highest rated investing apps in the world, and I'm sure they'll love it.
Fantastic. Thanks again, Emmett. For everyone listening, we'll catch you in the next one.